Hello and welcome back to Hurdle Rate. Today we're going to build the WACC and the cost of equity for MercadoLibre. MercadoLibre is an e-commerce company, a fintech, also a fintech company that operates predominantly in Latin America. And as you can see on the graph here, it's over the last few years it has been, on a very strong upward trajectory, looking almost 3x up. But in the last few months, that has started to turn. So today we're going to build the discount rate, and then in one of the next videos we'll build the DCF to see what the intrinsic value of the stock is. So yeah, let's get cracking. First of all, open up the latest 10Q, and this is for the first 6 months of 2025. And obviously you have your Excel spreadsheet open. First thing to do, as always, is to take off the grid lines and make this A column a bit smaller. I'll zoom in a bit more. Yeah, there we go. And in this top, put MELI, which is the ticker for MercadoLibre. Then we go data, stocks. Here it comes. We go MELI. There we are. And let's remind ourselves what the WACC is. The WACC equals the percentage of equity multiplied by the cost of equity plus the percentage of debt multiplied by the cost of debt multiplied by 1 minus the tax rate. And so that's what we're going to be calculating. To calculate that, we need the market cap. Let's just make the B column a bit longer because we've got plenty of things to put in there. Well, longer. What do you call it? Longer. Well, components that have a long name. Sorry, it's been a long day. Cost of equity, percentage of equity. So market cap, percentage of equity, cost of equity. And then the cost of equity is the risk-free rate, the beta, the equity risk premium, the ERP, then we have debt, the percentage of debt, the cost of debt, the tax rate, the total, and what's the next bit? The WACC. There we have it. Whoa, no. This needs to come back. Column width. Put it to about 20. So market cap is quite easy. We just go A1 parentheses market cap. Now remember to divide by 1 million because the statements are done we do these in millions. So 110,585 means that MercadoLibre's market cap is 110 billion 585 million. And then we'll save the cost of equity because we're going to do that on another sheet, but we can work out what the debt is, and we do that by going to the balance sheet. So let me just remember what page this is on, number 19. Let's go to the balance sheet. Where's I want the better balance sheet that we can find. Here we are. So the total debt for MercadoLibre is this 3.8 billion plus 3,484. Yeah, we'll do that. So equals, what did I say again? 3,818 plus 3,484. And just do a nice bit of formatting. Number. And so for total, it's the market cap. I will do sum the market cap plus the debt. And that gives us 117,887. There we work out our percentage of equity as the market cap divided by the total, and that's 93%. We'll just format it into a percentage. And for the debt, you just take the debt and you divide it by the total there. And just format it like that. We can find out the tax rate and the cost of debt theoretically now. Let's just do that quickly before we start building out the equity, the cost of equity. So income taxes. So 28.5% for the tax rate. And the cost of debt, let's see if they... No, that's not it, that's something different. It is... The best thing for us to do is just go to the income statement and we just look what the interest expense was. So 75, let's just multiply that by 2 to get an annual figure. Equals 75 times 2 divided by the debt. So yeah, it's about a 2% cost of debt. Okay, yeah, let's start building out the cost of equity now. Open up a new sheet. As always, we go page layout, we take off the grid lines, and then we make this, sorry, 1 second. Yeah, we make this column smaller, make this one larger. Actually, just undo that, undo both, go view. Freeze the first column and then insert a column on A. So we have 2 columns, make A smaller, make B larger, and let's start. We put an X in here to show that it's the start of a section. Just let me zoom in as well for you guys. It doesn't need to be that far really, but we're just going to do a bit of formatting. Fill, we use, which blue, where's my blue gone? Yeah, there we go. Font, put it to white so that we can see it. And this is cost of equity. We put the first thing, there we go, then we put risk-free rate, beta, equity, risk premium. Then we can here just put a border between these two because it shows they separate on the bottom like that. And if we remind ourselves what the cost of equity is, it is, so the cost of equity equals the risk-free rate plus the beta multiplied by the equity risk premium. And that's what we'll be calculating. And I'll leave that there for now. The first one we do is the risk-free rate, and this is always the easiest because it is the US 10-year, where is it? 4.119, 4.119%. We put US 10-year risk-free rate. And that is 4.119% equals there. So there we have it. The risk-free rate, 4.119%. And we just pull it up and we go equals here. There we go. And even though this is predominantly a Latin American company, it lists in dollars on the US stock market. Therefore, we put the risk-free rate in dollars. So what's the next one? The beta. Now we need to break this company down by industry. We need to see the sample size. We don't need to put that in there, but I do it out of habit. Revenues, EV to sales, value, proportion, the weighted. I mean, that's all we need. Just bold these. So MercadoLibre generates its revenue in two ways. One is the e-commerce, like the Amazon style business, but the other is a fintech, which is its own sort of, I guess, PayPal or Square. And where are we? Okay, yeah. So I need to get back to page 19. And there's a nice breakdown here. So you have your commerce services, commerce product sales, and commerce product sales, and then you have the fintech part. So we'll do retail first. I have another spreadsheet for the total betas. This is downloaded from Professor Damodaran's website. He lists them all on there, so they're easily accessible. We're going to let's zoom in a bit. So, okay, we can say that it's financial services. That's for the fintech part. And then probably retail general, to be honest. And software, internet. Let's go with those two. I'll filter down so that we financial services. Where's retail? Come back. Retail general. No, it's not real estate, sorry. Retail general. Then let's go with software internet for now, and I'll zoom in a bit more. We don't need the levered because we're doing free cash flow to the firm. This company doesn't pay a dividend, so we're going to use the unlevered beta. So no, we don't even need this. We just need the average unlevered. Here we are. Yeah, that one. So financial services, retail, and software internet. Let's see how we're going to break this down. So this one can be commerce services can be software internet. Commerce product sales can, would it be retail general? The financial service, all of these, I think we just put into the financial services. So this really is software internet because this is it's almost like a third party, and then this is from its own inventory. So, okay, yeah, we're good. We're good. Let's go. So, commerce services is software internet. Then retail general. Then we have then we'll go financial services. Where is it gone? Sorry, 1 second. Okay, yeah. So 0.27. I'll come back to sample size in a second. Let's just get these in. No, there we go. That's better. So 1117, 253, 147, 1.04, 1.32. Quick bit of formatting. Number 2, yeah, that's good. Number, there we go. Okay, now for revenues, so software internet is this one, 3028. 3028. Retail general 811. Then fintech 2951. Let's just get a so the EV to sales now, we get that from another one of the spreadsheets. So let me just pull it across. There we go. We need, so we have software internet, we need retail general, financial services, there we go, EV to sales, and this is to work out the value of each of those revenue segments. So financial services 19.3. A very lofty valuation. Retail general 2.05. Nope, that's not right. Then what was the last one? Software internet is 7.59. So the value of each of these segments is and then we get to take the full value. So the value of those three revenue segments, when you add it all together, it's just under 82 billion. So what we want to work out now is the proportion of all of those. So that this way we can calculate our weighted beta. So you take the value divided by the total value, lock in the total, because we're just going to bring all of this down. Then yeah, perfect. Okay, now the weighted beta, you just take the proportion and you multiply it by the unlevered beta. Pull that down, and then we just go sum. And there we have it. We have a beta of 0.58. Okay, now on to the equity risk premium. And this is probably, for most, for a company certainly like MercadoLibre, the most complex part because it has revenues from so many different regions across Latin America. So what we're going to do is we're going to say, what do we need to know? So we put the year 2025. We're only doing half year on these because of that's what we have the earnings for. Then weighted ERP. And we're going to say Brazil, Mexico, Argentina, other. So the revenues for Brazil, what are they? 3473. Okay, so Brazil, Brazil is more than twice Mexico revenues. Mexico and Argentina are on par, which I found was surprising actually. I'd have thought Mexico would be significantly higher than Argentina. And then the other countries, so this would include Chile, Bolivia, Peru, Colombia, Ecuador, as well as I think a few Central American countries too. Uruguay's in there as well. So we'll come up with a risk premium for this. It doesn't have to be that accurate because it's such a small part of this total revenue, but these ones we need to make sure that we're as right as can be on. So 3473. And Mexico is 1506. Argentina 1527. Then 284 for other. So let's sum all of those up. 6790. Now the weight of those. Okay, let me just take a lock in the total because that way we know. Just copy it all the way down. And then there's ERP. So let's go back to our country premium. I'll pull this across. So if you can see this, the equity risk premium for Latin America and the Caribbean is 9.51%. So, but I think really we want to be doing this, we want to break them down. So Central and South America, what was that? What did I say it was? 9.51%. If you take Central and South America, it's 9.3%. But we have, so Brazil's only it's not 7.91%. Okay, so Brazil is 7.91%. Argentina, 19.01%. Sorry, I will come back to Mexico. No. The Mexican ERP is 7.03%. Then this other. So the main revenue from this is going to be from Chile, Chile, Uruguay, 6.57, Colombia, 7.46. Panama, I think with the majority coming from Chile and Uruguay, let's say call it 7.1%. But it's such a small part of the ERP that we don't need to be worry about it too much because we don't have the breakdown, so we'd only be speculating. So the weighted ERP we need to like that. Pull it down, then we go sum 10.18%. That's our ERP for equity risk premium for MercadoLibre. If we'd used, as this is a US company, if we'd used the US equity risk premium, it would be about 4%. So it would not give us it would give us a terrible, it'd give us a terrible idea of what this company is worth, because it would be using US and North American risk rather than where the regions where the company generates its revenues from. So yeah, there we have it. 4.12% for the risk-free rate. The beta is 0.58. The equity risk premium is 10.18%. So now let's use this formula and calculate the cost of equity. So we go risk-free rate multiplied, plus the beta multiplied by the cost, the equity risk premium. And there we have it, 10.048. Let's just put these two in brackets to make sure that we're not is doing it in the right order. So now what we do, we can go. We can put all of these on, because it's good to have them on the WACC page. So yeah, let's just do that again. It's the risk-free rate plus the beta multiplied by the equity risk premium. Okay, now we have everything we need to calculate our WACC. So we're going to use this formula. The WACC equals the percentage of equity multiplied by the cost of equity plus the percentage of debt multiplied by the cost of debt multiplied by 1 minus the tax rate. So let's begin. Let's put the first part in brackets, so the percentage of equity multiplied by the cost of equity plus the percentage of debt, multiplied by the percentage of debt multiplied by the cost of debt multiplied by 1 minus the tax rate. Now just remember to double bracket at the end, because you have a bracket here and a bracket here. So we need 2 at the end. And there we have it. Just format it to 2 decimal places. And there's your WACC, 9.51%. So yeah, in the next video, what we're going to do is we're going to build out the full DCF for MercadoLibre, so that we can hopefully find out what its intrinsic value is and whether it is a good, or based on its ability to generate revenue and cash flows, whether it is a good buy or not. But anyway, thanks for listening, and I'll do the next video tomorrow. And yeah, I'll see you then. Bye.